I hope everyone is having a fantastic day. Today we are taking a look at the oil and gas sector, and we LLB talking about natural gas specifically. I also want to show you a few charts. I want to talk about the European Union in particular because they're doing something very interesting. Now, remember, the reason why we've seen such a dramatic move down in the natural gas market over the last several months, the best part of 12 months actually is because of the increased production. Production was flooding the market, and that was bringing prices down. So the problems in the Middle East, the problems in Eastern Europe, all of those factors add a premium to the price of natural gas. Now, in particular, the EU is now considering a price cap on Russian oil imports. They're going to try and limit the amount that they pay Russia for the oil. One thing that is interesting here is we're seeing a little bit of resistance above the previous uptrend line. And remember, we've got a lot of demand from Asia as well, especially China, which is recovering from COVID. So in the near term, I think we're going to see continued strength in the market. But again, we're starting to fade these highs. We're starting to see some resistance at these high levels. Trading derivatives carries a high level of risk to your capital, and you should only trade with money you can afford to lose. Trading derivatives may not be suitable for all investors, so please ensure that you fully understand the risks involved and seek independent advice if necessary. And that's why I think that the best strategy right now is to fade the rallies and look for opportunities on the downside. Now, this is a market that is simply lackluster, so exhaustion might offer an opportunity. Maybe we'll breach to the upside. Maybe we'll breach to the downside. If we were to break above the previous uptrend line, then we could go look into the $3.75 level. From there, we could potentially look to the top of the overall range, which is at about $4. But that's a long way away. I think that right now, the most likely scenario is that we're restarting to see prices peak out around the $3.50 level. And I think that any rallies from here are going to be... Any significant drop would probably be met with buying interest. I think that the market is starting to get a little bit nervous, and that is creating a lot of volatility and a lot of opportunity for traders who can navigate this choppy environment. But I think in the short term, the market is looking a bit tired. So I think that you really need to pay attention to those fundamental factors that we talked about earlier in this video. If demand starts to exceed supply, if production cuts are announced, if geopolitical tensions increase, if the Europeans decide to implement a price cap on oil imports or natural gas imports, then we could see a sharp rise in prices. But right now, the market looks a bit tired. Fundamentally speaking, we could see some upside in the short term. But in the intermediate term, I think we're starting to approach a top. When we take a look at the 200-day EMA, we see that right now we're hovering around it. We're bouncing off of it. We're sort of consolidating in this general vicinity. It's also worth noting that we're starting to fade the high. We're starting to put in lower highs. And that suggests that we're seeing a fair amount of selling interest at these higher levels. Now, obviously, this is going to hurt Russia. However, it's also going to mean that the EU is paying more for their natural gas. And that's going to bring pressure on the rest of the market, especially if the Europeans are buying more natural gas. And that's the argument they're making, that, hey, we need to limit the amount we pay Russia, and therefore we need to limit the amount we pay OPEC, the countries in the Middle East. Otherwise, they'll simply increase the price to make up for the shortfall. So they want to drive prices down in Russia, and they do want to drive prices up in the rest of the world. Now, that's a tall order. It's a tough balance to strike. But nonetheless, this is something that they're actively discussing and debating in the European Union. Production is now coming back to earth a little bit and bring down the price of gasoline, diesel, and jet fuel. But that has had little impact on the price of natural gas. And really, what is happening is you're seeing the price of natural gas decline, even in the face of all of that. So that tells me that the market is starting to find a new equilibrium. It's a higher equilibrium than we saw last year, that's for sure. But it's an equilibrium nonetheless. It's normalizing, if you will. and that is putting a little bit more pressure for prices to rise. I think one of the most important developments in the natural gas market over the last year has been the increased exports to Europe. So remember, the United States has stepped in to replace Russian gas with American gas. Well, what happens if those exports start to decline? Well, that would mean less production in the United States, which would lead to higher prices. And I think the market is already starting to factor that in. It's not a question of if that happens. It's a question of when that happens. And I also want to share some technical analysis with you in terms of where the price of natural gas could go next. We're looking at natural gas futures inching up. This is just the latest of many signals that tell me that we are seeing a bottoming process take place in the natural gas markets. And the reason why that is the case is because they're trying to prevent producers from dumping too much natural gas into the market. Now, if they dump too much natural gas into the market, they'll bring the prices down, right? They'll try and incentivize the market to produce more by bringing prices down lower. Well, guess what? Prices are quite high right now. So producers are incentivized to bring a lot of product to market. And that means that the 2024 contracts are starting to trade at much higher levels. In fact, we're starting to see the gap between the 2023 and 2024 contracts start to narrow. So that's also adding to the bullish sentiment in the market. So I want to talk about that today. Before I get started, let me know if you'd like to see gold and silver content. They're fun to read and they're well written. So let me know in the comments below. I do have a team of writers, and they are writing these incredible breakdowns. These technical they are fascinating. So I want to talk about some reasons why the natural gas market is inching upward. So let's get started. Reason no. One, why we're seeing the natural gas market inch upward is simply because demand is starting to outstrip supply. Reason no. Two is because we are likely seeing a floor on prices being put in. Remember, we talked about the 2023 contract. And finally, when we're looking at why natural gas prices are rising, it's important to remember that geopolitical tensions are always looming large. Now, how about the United States? Well, we've seen the United States release some of their strategic petroleum reserves to try. Let's take a look at the natural gas futures market. There's another thought I want to leave you with as we finish up here. Okay, let's get to the chart. Now, longer term, I do think that we continue to see the market grind higher because heating demand is going to increase in Europe. So my base case scenario right now is that we're going to consolidate in this general area. So I think that you need to pay attention to the dips in the market. All right. Thanks for watching. This channel is for educational purposes only. It should not be considered investment advice. Past performance is not indicative of future results.